When listener Chris Fraley, Chief Investment Officer at Realty Mogul, suggested that I learn more about my guest today, Geoff Dohrmann, I figured that as I do have an interest in the emerging visibility of crowdfunding in the institutional investor world, what better way to learn more about him than to invite him on my podcast? Adam Gower here, and you're going to be hearing today from the founder of the foremost media company providing information on real estate investing to the institutional investment world. Geoff is Executive Chairman, CEO, and Editor-in-Chief at Institutional Investor Inc., IREI. And the story you're going to be hearing from him in today's show is of the evolution of mass communications with a singular focus on real estate, specifically oriented to institutional investors. From producing a monthly journal on paper to the migration to digital media, Geoff has seen it all. He talks about how real estate was a minor sideshow for investments by institutional capital when he started 30-something years ago, and how it now represents a significant proportion of the capital formation market for real estate. And importantly, that maybe, just maybe, real estate crowdfunding is on the same growth trajectory, and why. Listen for Geoff's insights into how to predict the future by keeping an eye on the peripheries. You can find out more about Geoff on the podcast page for today's episode at gowercrowd.com, where you can also subscribe to the free Gower Crowd newsletter, which is the only newsletter that covers news and updates exclusively from the world of real estate crowdfunding. Sign up there at gowercrowd.com. All right, here we go. You're in for a treat to hear from such a leader in the real estate industry. So without further ado, it is my great pleasure to bring you Geoff Dohrmann, Executive Chairman, CEO, and Editor-in-Chief of Institutional Real Estate Inc. Geoff, it's such a pleasure to meet you. We've already been chatting. Thank you so much for being on the podcast. I do have some specific questions for you, though. My first question, this is very, very high level. You are Executive Chairman, CEO, and Editor-in-Chief of Institutional Real Estate Investor, correct? IREI.
It's called Institutional Real Estate Americas and Institutional Real Estate Inc., which is the parent company. So, and we also have editions in Europe and in Asia Pacific, and we have an infrastructure publication and another publication for private wealth advisors called Real Asset Advisor. So there's a whole family of different things that we do.
My question is that in every single one of those names is the word institution. So at the highest level, we're going to dive deep. Forgive me for asking a very simple, rudimentary question. What is an institutional, or what is an institution in your world? What defines
an institution? Is an organization that is geared to manage money for the benefit of third parties. At least that's how we define an institutional investor land. So that could be a life company. That could be another form of insurer. It could be a pension fund. It could be a real estate investment trust. It could be an endowment, a foundation, a sovereign wealth fund, a family office, a professionally organized family office. Anywhere where you have investment professionals managing money for the benefit of third parties, that is an institutional investor type relationship.
And so what is your audience demographic? Describe to me kind of the classic consumer of your content. What do they do?
I would say our audience is ridiculously small. All right, it's global, but there's really only about 7,000 to 8,000 major financial institutions around the globe that are dabbling in real estate. There are many more institutions. Not all of them invest in real estate or infrastructure. So our audience is institutional investors who are managing money for the benefit of third parties in real estate or infrastructure or other real assets like ag, timber, commodities, energy, things of that nature. Yeah.
And their primary focus is on not on stocks and bonds. These are alternative assets.
Well, the people that we deal with are primarily focused in stocks and bonds, but they're swimming in a bigger soup, right? They're part of an investment team at their organization that is managing across the entire asset spectrum. And the whole principle behind it really comes from the work of Markowitz many years ago and modern portfolio theory, the idea that if you spread your assets and mixture assets across the spectrum of risks, that overall you'll get a better overall performance no matter what the economic scenario might be. So this whole idea of asset allocation driving the investment decision-making process is really what it's all about. So it starts with a CIO, a chief investment officer, saying, what's the best way to allocate our assets based on our liability stream that we have to fund? And most of these institutions have liability streams. A life company has all the mortality tables, or the the casualty experience tables that they have to deal with. A pension fund has also mortality tables and payout obligations that they have to meet. Pension endowments, foundations, sovereign wealth funds, they may have a certain payout obligation that they have to fund whatever mission that they have set, but all of them are trying to figure out, how do we fund that liability stream, that obligation that we have? And they work backwards. First, they have to understand what their liabilities are. And the second thing they have to figure out is, what's the best way to cover those liabilities with what kind of asset mix? And they try to create an asset mix that operates along what they call an efficient frontier. It's a line on a chart that will operate optimally depending on what kind of environment, because nobody knows for sure what's coming. Could be hyperinflation, could be stagflation, could be low inflation, as we've had for so many years, could be high interest rates and low inflation, could be high interest and any number of different things. What's going to perform the best? And so they use these models, very sophisticated models, to figure that asset allocation. And they assume that more of the return will come from the way in which they mix up the assets than from the individual performance of any individual manager or any individual asset class. So there's a lot of adherence to this. And what a CIO will be doing throughout the whole process is rebalancing. So let's see equities outperform what their expectation was, but real estate underperforms. Well, they're not going to put more into equities. They're going to actually reduce their equity exposure and increase their real estate exposure to rebalance the portfolio to come into line with the asset allocation model. Sounds nuts when you hear it on the surface, but if you understood the mathematics behind it, you'd understand why it works. It just works.
So what is the value that you bring? What's the biggest value that IREI brings to that cadre of?
Well, I'd have to go back in time. When I first started my business, I really patterned it after and modeled it after a business that was built by a young American stock exchange analyst named Gil Kaplan, who started a magazine called Institutional Investor Magazine. And it's won numerous awards over the years. It's been sold a number of times. But his thesis when he started that in 1966 was that the ownership of assets in America and around the globe was shifting from the hands of individuals into the hands of institutions. Capital was being aggregated. There were professional asset managers coming in. At the time, what he meant by an institutional investor was a mutual fund, right? So he figured that they needed a different kind of information, right? Strategic information, top-down information, because the first consideration they have is asset mix. The second consideration is asset performance. And also it was a world where increasingly during the time that he started it up was shifting towards an independent money management mod. So the institutional investors didn't have the ability to build out huge staffs to manage their money, so they hired in third-party investment managers, professionals to manage that for them. So now all of a sudden what they needed to monitor was what was going on in that world. Who were the good guys and who were the not so good guys, and who was outperforming, and what were the issues you had to think about, and what kinds of investment managers were the best, all these kind of issues, which weren't what traditional investment publications were covering. So we created a new kind of information. So what I saw happening in 1989, 87 when I started, was that the same thing was happening in real estate that had happened, 30 years, 20 years earlier. And the ownership was going from the typical entrepreneur, developer, owner, operator guy to the hands of professional managers. Now it's way early. We figured that entire market cap of the institutional real estate investment business in the United States in 1987 was about 90 billion. Today there are 8 investment managers with more than that under management. So the business has scaled tremendously. It's over $1 trillion business today. So my vision was right. My timing was a little early. And so it took a number of years to really kind of get out of, living paycheck to paycheck and hand to mouth. Many years to get out of it.
That's really interesting you said that. So what was it that created what I'm assuming was like that hockey stick growth for you? What drove that?
There was all sorts of things that happened, and all of them mostly external to our business. The first thing that happened was that actually before we started our business was the mutual fund meltdown in 1974. And I was still in college at the time that happened. He wasn't even aware it occurred, right? But we just gone through an energy crisis, and the mutual fund market melted down, and so did the real estate investment trust market. Both of them melted. And people were looking for alternatives. So what happened out of that was that institutions turned from mutual funds as their primary source of managing money to specialist money managers. And at the same time, real estate investment managers had started in 1971, 72, when the Prudential Insurance Company of America, now known as PGIM, started what was called CRISA, which was the first open-ended fund, which was a real estate investment vehicle designed by an actuary, a guy named Meyer Melnikoff, to make it possible for institutions to pool their money and invest in real estate, similar to the way they were pooling their money in mutual funds. But when the mutual fund market exploded, all of a sudden people started to turn to other kinds of vehicles. So all of a sudden there were open-end funds, there were closed-end funds, there were separate accounts. All of this happened over time. Then in '84, the Tax Act hit, the Economic Recovery Tax Act of 1984. And that restructured things and introduced accelerated depreciation. And it also removed the barriers for savings and loans and other types of thrift-oriented institutions to get into lending on commercial real estate assets, which they'd never been allowed to do before. They were originally chartered just to fund savings and loans. So that started an explosion of real estate syndication for individual investors and real estate investment by institutions. In 1984, people lobbied the state of California to change their charter for the state pension funds to allow them to go off what was called the legal list. So they could only invest in certain kinds of securities that were on a legal list of securities, blue chips, and exchange that for the prudent person rule. So when they did that, all of a sudden CalPERS could invest in anything, including real estate, which it started to do. Once they started to do it, they're kind of a bellwether. A lot of other public pension funds started to move there. Not all at once, but eventually. And so what happened at the same time that this was going on, corporate pension funds looking at defined benefit pension funds were saying, wow, these things are really expensive to run. Why don't we just close them down, freeze them, and force our new employees to move into a defined contribution pension plan? Because legislation has just been passed to allow those to exist. So all of a sudden the corporates started moving out at the same time the publics were moving in a big way. And the publics were growing faster than the corporates anyway, because government was growing faster. And it just snowballed. More and more pension funds started moving into alternative investments like real estate, venture capital, private buyout funds, and the hedge funds, and all sorts of different things. And real estate was part of that, wrote it up. When I first started the publication in 1989, the average allocation of a large pension fund was about 3.25% for real estate. And most mid-sized and smaller pension funds had no real estate. Today, the typical allocation of a large pension fund to real estate is 10% of their assets. In some areas, it's even higher. And a lot of smaller pension funds are also participating, but weren't.
So Geoff, what is the value they derive from? What is your mission? And what was it then, and how has that evolved? And what is it today?
Our mission has always been to be the most reliable source of information on the institutionalization of the real asset classes, and to help improve transparency, reduce costs in the business, and to break down the barriers to enable good, solid communication to occur between people in the business. So that's been part of our mission since the very, very beginning. And I notice I didn't say to be the first to get information out. Institutions move very slowly, and they move very methodically, and they have to really be careful in their underwriting and due diligence to make sure that they're making the news correctly. So getting news first has never been important. Getting news right is really important. And so we really focus on that. Part of our values is to take the high road. So we've never washed dirty linen in the public. We're not kind of a trash rag that's looking for the latest scandal. If there is one, we'll publish something about it, but it's usually very balanced and not sensational. And it's give me the facts, because that's what I want. Now, you have to understand, reading our publication isn't for everybody. I remember one of the guys that worked for me that used to work for Savings and Loan, the Savings and Loan executive got a copy of it. And he called him up and said, "Did you read it?" He goes, "Yeah, I read it." He goes, "What'd you think?" He goes, "It's as dry as belly button lint." I'd like to think we're a little bit more interesting than that, but we're not written for a layperson. We're written for a professional institutional investment manager or investment professional at a pension fund, at a sovereign wealth fund, at a life company, at a family office, who's trying to make sense of the huge volume of information that's coming in. When we first started, there was no way to get information at all. So that was the role that we were playing, we're filling an information gap. Today, it's the opposite. There's too much information. So now we act as a curator of information, so that you're getting the information that is most relevant to you as an audience.
And what have been the biggest, as a media company, what have been the biggest challenges for you over the years as the industry has grown?
Well, first of all, keeping track with our audience, because it's changed over time. When it first started, real estate was considered to be office, and really only CBD trophy office in major cities, industrial, and really only warehouse distribution properties, and retail, and really only regional malls. People would say, "I'd never invest in anything with beds." So apartments were out, hotels were out, senior housing was out, student housing was out, none of those things. Today, all of those things are part of it. So we've had to expand as we've gone along. The other thing is the structure of the investments has changed. When we first started, everybody was investing through group trusts because of ERISA. Now everybody's investing in a million different structures, including, special acquisition corps and, private REITs and limited partnerships and LLCs and a million different kinds of structures that they're using. And so we've had to stay on top of all of that as well. And then they've expanded out into other alternatives like infrastructure and other real assets. And we've had to stay on top of all of that. In the middle of it all, as I mentioned when we were chatting earlier, we shifted from a paper-based production process to desktop publishing. And then right when we thought we finally figured that out, isn't that great? The internet came along and all of a sudden completely undercut the value of the information we were providing 30 days late. It had to be provided on a daily basis. So we had to shift our platform from being primarily print-based to being digital first. There's no publisher on earth that had to make this transition where they fail. And then you got to figure out, how do you monetize that? Because people's appetite for information on the internet is limited to what they can get for free, mostly. People are somewhat reluctant to pay for it. And so we had to find a way to monetize that over time. So lots of different things that have happened over time. We tried a million different things that didn't work. I think I'm telling the story of most entrepreneurs. And I think what's interesting about entrepreneurship is that there are far more entrepreneurs who are really creating value and creating new products and new areas and new ways of doing things. That'll be more like my business than Bill Gates or Steve Jobs or the guys that get the headlines. For every one of those, there's thousands of us. And what we're going to create is a good business, maybe some wealth for ourselves, maybe some wealth for our investors, but it's not something an angel investor or a venture capitalist would be the least bit interested in, because they're not scalable businesses. They're not going to get up to be multi-billion-dollar businesses. They might get up to be 20 or $30 million businesses. And so it's interesting. The things that I've gone through are the things that every entrepreneur.
So let me ask you then, looking back on your career and where you are today, what have been if you were to start again, monetizing, what would be the best methods for doing that? They cut all the failed efforts, right? Pathway to success. What are the best ways?
I think the formula that we've settled upon works. But if I were going to give advice to an entrepreneur, I would give a different set of advice. It depends on what your goals are. To me, the first goal has to be to create something that's going to be of service to humanity of some kind, either narrow niche or broad, right? But if you don't have passion for being of service, I don't think you're going to have much success in business unless you get incredibly lucky, right? But on the other hand, as long as you're going to be doing that, you might ask two other questions. The first question is, what's financeable? What will people lend money or invest in, right? And today that is not publishing ventures, I guarantee you, right? The second thing is, how scalable is it? Can it scale? Because your ability to attract capital is going to be directly related to the ability to scale the business. And the second question is the most difficult to answer correctly, because you have a tendency to want to believe your own BS and overinflate what you really can deliver over time. It's kind of called the optimism bias by scientists like Daniel Kahneman and others that have done work in this area. We all tend to be too optimistic. We think we'd accomplish more with fewer resources than we need in a faster time than we're actually going to be able to do it. So all of those things really are important. And you also have to ask yourself, can I manage? And that's a big, really different kind of thing. Most entrepreneurs can't. They're driven by the wrong things. And so if that's the case, you've got to be willing to bring in management people to take over the management responsibilities, to really run the nuts and bolts, because managing is entrepreneurship is all about responding and reacting to what you're seeing in the environment, putting together puzzles and patterns that other people don't see and acting upon. Management is about doing the same damn thing day in and day out. It's boring, it's methodical, but it needs to be done. And you got to absolutely adore people, and you absolutely have to have no ego, and you got to be able to put all the light on the people that are working for you and take the light completely off yourself. Not everybody's wired to do that.
Now, your primary monetization or your primary revenue streams are from subscriptions and advertising, presumably?
No, I would say not at all. I would say a relatively small percentage of our revenue base comes from subscription sales, because first of all, our publications are like many trade publications, controlled circulation, meaning free to qualify. So if you're an investor, an institutional investor is the way I defined them earlier, you're eligible to receive the publication at no charge, right? Now, normally that is underwritten through advertising sales. But when I first started the publication, I went out and talked to people, and all of them said, I don't want to advertise. Advertising isn't what we want to do. It's not consistent with our culture, right? So I had to come up with a different model. And through stumbling through a bunch of models that didn't work, we stumbled across a sponsorship model, which was patterned off of public radio, public television sponsorship, under the assumption that if you're creating a public good, then people will step up and underwrite what you're doing and help make it possible. So 60% of our revenues today come from sponsorship, not from advertising. Now, sponsorship benefits include advertising, advertorial, networking events, both virtual and in person, consulting hours, research. We have a database called IREIQ, subscriptions to the database, lots of different things. So it's kind of a bundled product. And we tell our sponsors, we really see ourselves as an extension of your marketing department. Our role is to help you, position your firm. There's really three things. One is to get noticed and stand out. It's a crowded field. Right now, there's over 1,000 offerings in the market competing for the time and attention of a limited number of institutional investors. Second is you got to get differentiated. You got to help people understand how your offering, how your company is differentiated from those of your competitors. And the third thing that you have to do is you have to get connected with the right people. So our sponsorship program are designed to help people do that cost effectively. Could they do those without sponsorship? Sure. Can they do them more cost effectively with sponsorship? Absolutely. And that's why it works. And our renewal rates are about 95%.
And
so,
sponsorship includes what, actually? It's like sponsored articles, like I presume it's thematic. Yeah.
Yeah, well, that's another thing. Everything we do from a publishing standpoint and an event standpoint is investor focused. So it's the investors we're serving. So when we put together an advisory group to advise us on how to put the agenda together for our conference, we don't even have investment managers or consultants on it. It's all investors. We want their views on what they want to hear and see and talk about, right? Our publications, we put an editorial advisory board meeting together twice a year here in the United States. We listen to 40 different investors talk about the issues that are keeping them up at night and the challenges they're facing in managing their portfolios, and use that dialogue to help curate the content for the publication for the rest of the year. And so everything is that way. If an investment manager wants to get an article in the publication, it has to be a sponsored advertorial piece. It has to be clearly labeled sponsorship. You will never see on the front page of our publication, even though they're a great firm, Blackstone leads the pack in large deal transaction volume in New York City. you know, that you'll see in lots of trade publications. You'll never see it in ours because it's not about what the LP or the GP wants or the general partner of these programs wants. It's about what the investors want. And, you know, we've been doing these meetings now for over 33 years. Never once have I heard an investor at those meetings say, you know what I really like? A lot more propaganda about management, right? It's not like they don't want it or they already get it. They don't need more.
So what are you actually delivering on the events though? If people show up to an event and they're sponsoring the event, presumably they're there to pitch something, to sell something.
Well, we don't allow marketing in our, if anybody starts pitching from the podium, we actually have a gong. It's a symbol of what our organization is, and they'll get gonged off the podium. So if they start saying, well, in my company, the way we do gong, doesn't happen very often, but it does once in a while.
And so these are educational, are they strictly?
They're strictly educational, and they're on topics that the investors tell us they want.
I see.
And second of all, the other thing that is true about all of our conferences, they're highly interactive. Our feeling is the time to fly 3,000 miles to go listen to a speaker is past. You can find that same speaker on YouTube, find exactly what he's going to say at the conference. You got no value from sitting in a seat, especially when you're sitting in a seat. And I'm Geoff Dohrmann, marketer for, you know, BlackRock, and I'm sitting next to Mike DeRay, the head of real estate for CalSTRS. I don't want to be listening to some guy talk about. I want to talk to Mike. So, and Mike wants to talk to his peers. So what we do during our conferences, a lot of our conferences made up of roundtable discussions, small group discussions where the investors have set the topics and people get together and talk about those things. And then when we have keynotes, a lot of times we'll have different kinds of keynotes. Like we had a gal who's written a book on introverts versus extroverts, right? Well, the dynamics of building relationships hinge around your understanding of these topics, right? We had a guy, Chris Kotarski, come in, who's in the adult education program at Oxford University, who's written a book comparing what's going on now with what was going on during the Renaissance, right? And comparing and contrasting. And so we talked about that. And he talks about the need to create new maps. You know, we all rely on these old maps, but they're out of date. They don't work anymore. We all have to create new maps. So we get around and talk about that. What does that mean for us? And so the conversations are really deep and they're really fun. And everybody's engaged. And nobody's sitting on their fanny having to listen to somebody drone on for hours about where are cap rates heading? Or what do you think interest rates are going to do? Or what is the Fed's next move going to be? Which we all have been way overexposed. If you've been going to real estate conferences or infrastructure conferences for more than 10 years, there's not much new you're going to hear. At our conferences, there's all kinds of new stuff that you're going to experience because it's all experiential as opposed to that. We'll also have afternoon events where people can get together and connect and network with each other. Like just at our editorial advisory board meeting, we broke for 2 hours, and we had a group come in and did these kind of trivia contests, right? We broke up into groups and did trivia contests. And when you won, you got a piece of a beehive, and when you got enough pieces, you assembled a beehive. And then everybody assembled their beehives, and then the truck came up and we delivered them to the local beekeepers nonprofit to help, you know, produce bees. Another time, we did the same kind of exercise with bike parts. And when it was all over, the assembled bikes, up ran the bus from the local orphanage. Kids came out, all got their bikes. You could see the look on their face. So
that's very cool.
We were all connecting with each other in a different way, at a different level, but doing something worthwhile at the same time. So that's it's really kind of fun. Nice. We've done hikes through the redwoods. We've done whale watching. We've done all kinds of different activities. The whole idea is to get people out of their normal day-to-day environment where the dynamic is investment manager pitch, investor resist, and get everybody on the same side of the table having fun together and connecting with each other and getting to know each other on a personal level. That's
so, Geoff, so how do you measure success? Right? These are very interesting ideas. Do you measure success through the increase in the number of subscribers or the increase in the number of sponsors or an email from somebody saying that was great, thank you? Like, how do you measure success?
Well, we measure success like every business does to a certain extent of the bottom line, but it's never been the driver for us. I think when people come up to me and say, you really need a difference in the business, you've introduced humanity into a business that's often cold and dark hearted. And you have really filled an information gap and made it easier for us to do the things that we do on a daily basis. That's part of how we measure success. Again, if I had wanted to get wealthy, I would have picked a different path than the path I've done. I've done all right, right? I could retire now if I wanted to. I don't want to. I never want to retire. As long as I can continue to contribute and do good things for people, I want to continue to do that. So, but
Geoff,
everybody's different. Everybody has their own drivers. You know, that's my driver.
Geoff, I have 2 pages of questions. We're almost at the end of it. You are a fascinating fellow, and I would love to talk more with you. We're going to have to wrap up, though. I hate to do this. I'm going to ask you a question. Actually, I came to you because, and I'm going to confess to this. I actually sent an email while we were talking because your name came up. Somebody contacted me, and I asked them if they had a question. I mentioned your name. They said, well, you know, let's Geoff Dohrmann should look into Geoff. And I asked them if they had a question for you, and they do. And I'm keeping an eye on my inbox surreptitiously to see if they'll let me mention their name. I'm waiting to see if it comes in. I can't do that until they say yes, but I still have the question, and here it is. He wants to know if you think there is a future for allocator funds now that everyone can go direct to great real estate sponsors without double promoting through crowdfunding.
Give me a time frame. You know, I think allocator funds are going to be around for quite a while. I don't think they're going to go away. I think that, you know, crowdfunding for institutional investors is what I would call on the periphery. Remember I mentioned Chris Kotarski, the futurist from Oxford? He says, if you want to understand trends, pay attention to what's happening on the margin. Because oftentimes what's happening on the margin is what the future is going to be. It starts out with people dismissing it. Nobody will ever do crowdfunding. To, oh my goodness, people are doing crowdfunding. To, my God, a disproportionate amount of them deals are transacting in crowdfunding. To, what's an allocator fund? But that's a long process. It doesn't happen over time. In the remaining part of my lifetime, we'll still see allocated funds. But that doesn't mean that the role of what we're doing won't be important. I also think on the periphery, something a lot of people dismiss as exotic and weird is blockchain. Blockchain is going to redefine our future in many different ways. People are saying, well, there's going to be all kinds of abuses. Of course, there is in everything. There is in crowdfunding too. That doesn't mean invalidate the idea of doing it. There's lots of crowdfunding in traditional ways. I mean, fraud and problems in traditional ways of doing things. You know, the future is what's going on in the periphery. You need to keep a weather eye on that as you're rebuilding your maps. And you need to build maps that incorporate these new technologies into them. We ain't seen nothing yet. We don't even know what crowdfunding is going to look like. You and others like you will be reinventing the future for all of us. And you'll do it the same way I did, trying a million things that don't work quite as well as the way you want it to.
Well, that's what I was asking. Geoff, that was I was asking what worked, because I don't want to have to go through. I mean, there's always going to be trial and error.
What works for you is going to be different than what worked for my business, you know, because part of it has to do with your values. Part of it has to do with your mission. Part of it has to do with why you're in business to begin with. And all of that will dictate what's going to work for you and what isn't. But I think, you know, the hardest part is determining what just needs more persistence and stay with itness, and what needs to be let go of. That's the hardest thing. And you really can't rely upon the opinion of other people because they don't know. So you really, the best thing you do is network with other entrepreneurs, talk to them, exchange. And the more you can network with entrepreneurs outside your area, you know, the more cross-pollination you get. A lot of the ideas we came up with were ideas we stole from other businesses, other industry sectors that work too.
Fascinating. Yeah, it's the idea of the pioneers who take the arrows, right? You got to be prepared to do that if you want to get ahead.
Yeah, well, you know, you got to be willing to be vulnerable and try some things. If you don't try anything new, you know, there's an old friend of mine years ago said he had a daughter that used to tell him, Daddy, if you keep on doing what you've been doing, you'll keep on getting what you've been getting. 4-year-old wisdom, right? But I think about that a lot, right? If you want different results, you really have to try different things. You know?
Geoff, like I said, quite seriously love to talk to you for a lot longer. And I do have some questions offline I want to ask you, one question particularly. But before we do that, let me ask you 3 sign-off questions I always ask all of my guests, if you don't mind. Rapid fire questions. First, what are the daily habits that you have that make you successful?
God, I really don't even know, because I tend to be not as disciplined as I would like to be about it. When I need to be successful and need to focus, time blocking is essential. If you don't say, I'm going to do this activity at this particular time, it always tends to get away from you. And what you need to time block are the things that you really normally would avoid doing. A lot of times that's making phone calls, because you're putting yourself at risk. So time blocking would be one thing. Talking to your people every day, to the extent that you can, is really important. Communication can blow a business up like you can't even believe. And then talking to your clients on a frequent basis. It's so easy to let 6 months go by and you haven't connected with somebody that your business rests on and depends upon. If we didn't have our sponsors, if we didn't have our subscribers, if we didn't have our advertisers, we wouldn't be in business. And so staying in touch with them, and also staying in touch with our controlled, even though we don't sell anything to the investors, staying in touch with them and finding out what's driving them and what's keeping them up at night is a critical thing. So that's 3. There's probably
that's 3, but actually that was the first question of 3. Second question, hardest lesson you've learned in business or in real estate?
Don't ever, ever, ever compromise your values. If you allow somebody in your organization that does not share your values, you will spend so much time, doesn't matter how productive they are, doing what one of my employees used to say, call scraping the toast. Her point was, it's always better not to burn the toast in the first place. And when somebody doesn't share your values, you spend a lot of time cleaning up the messes that creates. So that is the instant answer to that. It's absolutely the biggest lesson I've learned. Make sure that the people that you hire share your values. More important than anything else. You can train them to do just about anything else. You can't train them to value the same things that you value. You just can't. So that's been the biggest lesson.
That's very interesting.
And I learned, and by the way, I'm not through learning it. What I find in life is you learn everything at deeper and deeper layers. It's like peeling back an onion. You go, oh, I got it. The universe goes, really? Try this on for size. And you have to learn it just a little deeper. So, that's a life lesson for me.
My last question, it's actually difficult to write this one. I usually ask, what advice would you give somebody who's looking at investing in real estate? Well, this actually is a valid question, but somebody an individual investor who has never looked at real estate before, who has become exposed to it because of crowdfunding, right? They're not an institution. So it's like now crowdfunding has brought it to the masses, if you like. What advice would you give to them?
I'm not an expert in the crowdfunding space, so I can only tell you what advice I would give to any investor, which is really know the people that you're dealing with. My experience, it's another kind of lesson learned, is it's all about character. And if you're dealing with people of character, it doesn't matter what the contract says, they're going to do the right thing. And if you're dealing with the wrong kind of people, it also doesn't matter what the contract says, because they'll hire lawyers and find a way to get around the contract and put it to you. So if you're dealing with people of right character, they'll always do the right thing. And if you're dealing with people with the wrong character, you'll always get screwed in the end. So, that would be my advice.
Geoff Dohrmann, Executive Chairman, CEO, and Editor-in-Chief of IREI. Thank you for being on my podcast. It's been a real pleasure.
Thank you, Adam. It's been a pleasure. Thanks.
That was Geoff Dohrmann, Executive Chairman, CEO, and Editor-in-Chief at IREI. It's not out yet, but be sure to sign up at gowercrowd.com for our newsletter, because I will be sharing with you an article that Geoff is publishing that is astonishingly well researched, of course, on real estate crowdfunding that you will definitely want to read. So go to gowercrowd.com and sign up for our newsletter. It is the only resource of its kind that focuses exclusively on real estate crowdfunding and on the industry. It's totally free, and it covers all the latest news, updates, and information that you could possibly want on the industry. All there at gowercrowd.com. where you will also get a link to the article that my guest today, Geoff Dohrmann, is going to be publishing in the very near future. Thanks for joining me today, Geoff Dohrmann, Executive Chairman, CEO and Editor-in-Chief at IREI. And thank you for listening in. That's all for today. Be well, stay safe. And for now, this is Adam Gower signing off.